Our next guest joins us with his 2026 Outlook, JPMorgan senior analyst, Steve Tusa. Steve, thanks for being here today. Help us break down this sector, because I think it was maybe one of the more surprising winners of the year. Where within industrials do you see the most opportunity right now?
Yeah, thanks for having me. First of all, great to see JPMorgan making new highs, but putting that aside. Putting that aside, this year was kind of like a tale of two halves, where it was a lot of growth focus in the first half. Obviously, you had all the tariff dynamics. Things went up, they went down, and in June, we kind of made the comment the last time we were on, saying things were basically back to where we started the year. But really, in the second half, there was a dramatic divergence in performance. Obviously, everything in this group, you mentioned GE Vernova, Caterpillar, I don't cover those stocks, but they're still part of the same trade. Everything starts and ends with the data center trade. And while there's been a little bit of consternation recently about the sustainability and duration of the cycle, the demand for anything data center in the second half is absolutely off the charts and getting better through year end. So everything in this group, and anytime you talk about industrials, it's going to start and end with data centers. Where the divergence is mostly around residential, HVAC names I cover, and actually some of the cyclicals that have gotten cheap and are just driven by industrial production and general CapEx started to get a bid in the last really 3 months, and that's been a big divergence in the back half of the year. So, group has kind of performed below the S&P, up 7% versus the S&P up 15%. But significant divergence within, and maybe a little bit less concentration than we've seen in the prior year, in 24.
So then, if you're an investor and you're looking to kind of shift or reallocate your portfolio going into 2026, do you stick with the winners here? Do you stick with that AI data center build out trade, or do you opt for some of the names that may have been more beaten down here?
Well, my data center names that I cover, including something like Vertiv, just recently went into basically bear market territory. So this is officially a pretty significant dip and is a very different value proposition than what we may have seen even 2 months ago on, I would say some news flow. I think news would be probably a generous characterization, a lot of speculation in a negative sense. I would stick with that on the growth side. And then secondarily, to kind of take all this debate about where the economy is going, we really like idiosyncratic margin stories, and Johnson Controls would be the other one outside of Vertiv. Still has some data center exposure, but a really tremendous operating improvement story where earnings can grow 15 to 20% for the next few years, and the stock is pretty reasonably priced. So those are our two, and you could call them two parts of the barbell, but they're both kind of data center related. So not quite as expansive of a barbell as we've been in the past.
Yeah, it sounds like you don't want to be completely void of AI data center exposure here. What do you see?
Definitely not. We want more on the dip, no question. I think if we were to look elsewhere from a general economic perspective, Dover and DuPont are our favorite relatively cheap economic leverage plays. We're not quite looking yet at the residential HVAC stocks. Those are the ones they're down 20, 30% in the second half of this year. So there's a little bit of value appetite there. But we think people were too early to try and time that. So maybe next year, second half will be more interesting on that front. But for now, really sticking with data center, idiosyncratic margin, and then a little bit of economic leverage, cheap economic leverage, we can get it. How
does the risk of overbuild affect some of these names? It sounds like sentiment has, surrounding some of these issues has caused people to take a pause toward year end. But if there is a significant risk here, I mean, what do you see as kind of the downside scenario?
There is no pause in on-the-ground activity when it comes to building data centers. Full stop. It's actually better in the last several weeks than it was around the quarter end of third quarter, where everybody realized that we're still kind of earlier in this cycle, and there was a wave of order activity for the infrastructure-related players. I can't speak to what's happening down at the tip of the spear and the next model that's going to come out and how that leapfrogging is going to behave. I'm not a tech analyst, but when it comes to on the ground order activity and everything the hyperscalers have said about their supply demand position in their most recent comments suggests we are still early in this cycle where supply is trying very hard with little success to catch up to demand. So I think this discussion of an overbuild, again, as we've said before, we all die in the end. I'm an industrials analyst. This is a cycle, but in year 2 of a build out, that takes, I think, a little longer than just a few months. It's very hard to overbuild, and we still think we're a ways away from that. I haven't really heard of any dark GPUs lying around yet. So we're still pretty bullish, even from a cycle timing perspective.